In the fast-paced world of Forex trading, where market movements happen in the blink of an eye, the key to success lies in mastering the right indicators and strategies. And today, we are rediving into two of the most powerful tools every trader should have in their arsenal in 2025. The exponential moving average EMA and the relative strength index RSI. Both of these indicators are simple, yet effective in providing clear signals, but it's their combined use that can truly elevate your trading strategy. Whether you're a part-time trader looking to refine your skills or an experienced trader aiming to level up, understanding how to use these indicators together will give you a huge edge. Let's start with the EMA. Unlike the simple moving average, which gives equal weight to all price points in a given period, the EMA places more emphasis on the most recent price action. This makes it more responsive to market changes, allowing you to capture trends earlier than with traditional moving averages. By adjusting the EMA's period, you can tailor it to different time frames. Whether you're scalping on the 5-minute chart or looking for longer-term trends on the daily chart, but how do we use the EMA effectively? It's all about identifying crossovers. When the price crosses above the EMA, it's often a bullish signal. Conversely, when it crosses below, it signals bearish momentum. To make it even more reliable, many traders combine the EMA with the RSI to confirm entry points. Now let's talk about the RSI. This momentum oscillator measures the speed and change of price movements, helping traders identify overbought or oversold conditions. The RSI ranges from 0 to 100, and typically, readings above 70 indicate an overbought market, while readings below 30 suggest the market is oversold. By combining the RSI with the EMA, we can filter out false signals and spot high-probability trade setups. For instance, when the RSI is above 70 and the price crosses below the EMA, that could be a strong signal to sell. Alternatively, when the RSI is below 30 and the price crosses above the EMA, it might be time to buy. But what about risk management? This is where most traders go wrong. No matter how strong a setup looks, always use a stop loss. Place it just below the previous swing low for a buy trade, or just above the previous swing high for a sell trade. This helps you limit your losses and protect your capital. Let's take a look at a live chart setup. Here we can see the price action moving towards the EMA. Notice how the RSI is hovering near 30, signaling an oversold condition. With the EMA crossover to the upside, we've got a strong setup for a buy. Placing our stop loss just below the recent low, we're ready to enter with a clear risk-to-reward ratio in mind. The key to mastering these indicators is practice. You can start by backtesting your strategy on historical data and running simulations in a demo account. This gives you the confidence to execute real trades with precision. As you continue to refine your approach, remember that trading is a journey, not a sprint. The more you practice with the EMA and RSI, the more intuitive they'll become. Combine this technical knowledge with a solid risk management plan, and you'll be well on your way to becoming a successful Forex trader in 2025.